Hey guys, welcome to the first episode of Fund Strategy, and this is going to be a series of videos with some very unique strategies in investing and traditionally in equity investing, equities and the stock market and ETFs and funds like that. So a little bit about me. My name is Henry, and I don't know how many years of experience in finance now, probably going on 9 years in business and finance. A big income investor, growth investor. I just dabble in a lot of assets, crypto. I have a real estate portfolio, so I have some experience in all types of assets. And I decided to make this because it might be fun. It's going to be called YIELDSTRAT, so yield strategy, right? So big income, and we're going to do this in a very novel way. So I try to make this somewhat professional investment objective. We're going to get income and maybe some exposure to the share price of certain stocks or certain funds through income producing strategies. And the way this is going to work is we're going to have a 5-phased approach where we're going to basically front load all the risk into very high yielding ETFs. Going to shuffle those distributions basically into more stable, sustainable yields. And we're going to do this called the glide path approach. That's what we're going to call it. And we'll go a little bit more into it right in the next slide. So phase one, we're going to be looking at YieldMax ETFs. These are fairly new, very high risk. I'm not going to sugarcoat it. This is a high risk strategy, but we front load all the risk, right? We're fairly bullish on these funds that we pick. Bullish meaning that we expect the price to sustain or the price of the underlying securities to sustain. So we're going to go with some YieldMax ETFs, which are actually a lot of these use option strategies. So options is the actual agreement to buy or sell a stock at a given price, and they do these pretty unique strategies that basically create a bunch of what's called premium for being involved in the transaction. And that premium gets paid out back to the person that owns the ETF. And the more volatile the stock is, the more premium that gets paid out, because volatility causes options to be more valuable, actually. So phase one, we're going to ramp up with YieldMax, and these are been yielding some crazy yields. And a lot of these, they've been holding kind of strong, which has been kind of wild. And so an 85% yield. So we're going to do this for about 6 months. So the high risk ramp up phase. And then after 6 months of reinvesting into the YieldMax ETFs, we're going to have built up our little engine a little more, and we're going to go into the de-risking phase, where we're going to take all the distributions instead of reinvesting into YieldMax, we're going to push them out into a more moderate risk, 30% paying, which is still kind of risky, 30% paying ETF, maybe round hill ETFs. So we're going to invest into that, fund that for 6 months with the distributions. And then after 6 months, we're going to take all the distributions and we're going to fund a more moderate to low risk covered call ETF as well. Maybe triple QI, JEPQ, one of the JP Morgan Chase funds that yield less. And this is going to be the yield leveling phase. So the yield's going to start high. We're going to bring it down over time into a more stable yield. And the last part is we're going to look at this as a fund approach, right? The entire portfolio and the share price of the portfolio, right? And we want to stabilize that NAV, meaning we don't want the share price of the portfolio, YieldStrat, to start dropping because it's yielding so much. So we're going to put a more stable, lower yield, more high growth fund, maybe like SCHD. Maybe some REITs, and we'll look into that. We're really going to start bringing that yield down. And then phase 5, in perpetuity, we maintain that yield into, a more stable, sustainable yield. Even 12% is pretty high. And I think initially coming out of those first 24 months, we're going to be coming out of at a 45% yield. So we're going to have to really look at reallocating within the portfolio as well. So of course, this is risky, and that's what makes it interesting, makes it fun. But we have to identify those risks. And none of this is financial advice, but I wouldn't be, a good finance guy if I didn't make you aware of those risks. So the first three phases, we're going to be using very new high yield ETFs. They haven't been tested for too long. They haven't been really pressure tested as well. That's why it's a short term, glide path. And then we're going to move forward, right? So every time an ETF pays out a massive yield, you have the risk of what's called NAV erosion. So let's say a share is $100 and it keeps paying out 85%, for example, per year in distributions. You might not have that $100 after a year per share. It might be $50. It might just start cratering. So there's that risk. And that can happen if volatility dries up. That can happen if the underlying stock loses value. So we're going to mitigate some of that in YieldStrat by shifting capital, like I said before, into more stable funds and stocks, and try to maintain the NAV of the fund as a whole, right? So we're going to start at a share price of $100, and we're going to try to maintain, keep that NAV from cratering, ideally increasing with the distributions. Underlying stock risk, if you get MSTY, it's all concentrated in Microstrategy, for example. If something happens in Microstrategy, you're out of luck. So that's why we're going to also mitigate this by moving into more diversified option ETFs that hold a basket of options. So if one company goes down, it doesn't all go down. And then the way covered calls are done, there's limited upside participation. If MicroStrategy doubles overnight, MSTY, a popular YieldMax covered call, might not double overnight with it. Same if it craters, and then MSTY craters with it, and then the underlying equity, MSTR, starts to recover sharply. MSTY might not recover sharply, and you get all that NAV loss, essentially, or price appreciation loss. So that's why we're trying to shift capital into more growth-oriented stocks and funds down the road that are more sustainable to preserve our NAV and kind of keep everything moving upwards a little less volatile, in a less volatile fashion. And then tax inefficiencies, because you're getting paid out every month, every week. You're not just holding and selling off when you need it. You're getting, all those distributions or all those dividends. And we're looking at these funds that sometimes return of capital in some cases. And then NEOS has what's called a 1256 tax benefit. NEOS has funds like QQQI and SPY-I, and that allows a split 60-40 long-term, short-term capital gains tax treatment, with the long-term capital gains tax being much lower than short-term capital gains tax, which is basically your income tax. So there's some benefits in this, the way they do the tax counting stuff when they distribute these distributions. So for this, I guess, experiment, we'll call it, we're going to try to do quarterly reporting. We will do quarterly reporting, maybe a video update on how things are going. And we're going to take the whole fund, start with $10,000. We're going to split it by 100 into $100 a share, right? And then the share is going to represent the value of the underlying fund. Pretend it's like, hey, I bought a share from this fund at $100 a share. And then as we move through time, we're going to report on what that share is worth. Hopefully it'll be worth a lot more than the $100 that we start with tomorrow. And then, of course, you have to compare yourself against opportunity costs, against other methods of investing. So we're going to benchmark against the S&P 500, which is the 500 largest market cap stocks in the United States. Very decent general representation of the United States stock market, and it generally returns 9% annualized returns throughout history, sometimes more, sometimes less. And we might even compare it against the NASDAQ QQQ, which is more tech focused and grows a lot faster, but also can drop a lot faster too. No capital will leave the fund, the YieldStrat, for 2 years. So while we measure all this stuff we're going to measure the income, the appreciation, and then the total return. Everything is going to be rolled into that $100 share price, and we're going to retain all earnings and reinvest them for the first 2 years based on the strategy. I'm not going to say, oh, they paid me $200 this month, I'm going to take it and go spend it on something else. So a few things we're going to measure. Obviously, the returns, like I was saying, the differences in time, how much the stock or the fund grew or shrank, the income distributions that were paid out, and the combination of both. and then we're going to measure the beta. So we want to see how much the fund's volatility moves relative to the S&P 500. So if the S&P 500 shoots up and then the fund moves up 3 times more, obviously the beta will be much higher than the S&P 500, because if it tracks directly, the beta is 1. Alpha, we're gonna take into consideration that volatility and expected risk, which is the risk of the volatility, and we're gonna see if we generate excess return based on the risk. Standard deviation, just generally how volatile this fund is, the share price, and we're also gonna measure what the dollar number distributions are every month that the fund creates, or every week. So those are a few things that we're gonna report on, and should be interesting. If you look to the top left, you're gonna see a blended 92.5% yield right off the bat, because we're gonna go phase 1, full risk, MSTY and ULTY, and these are insanely high yielding funds. And right away, we expect to get almost $800 a month just from that initial $10,000. That's how it's going to go. All the monthly expected distributions. And if you look at the 92.5% on the top left, you can see if you're phase 1, it's going to keep yielding that amount, and then as it reinvests, and this is assuming that there's no NAV decay or NAV dropping, everything holds steady, and then it pays the same distribution. And then as we start allocating into lower yield, more sustainable ETFs, you're going to see in phase 2 the yield's going to start to drop, and then phase 3 the yield's going to start to drop again, and then the distributions will still come up, but not as dramatically as in phase 1. And then in phase 4 the yield just keeps dropping and distributions sort of level out as we move into a conservative yield and more sustainable NAV. So the first thing we're going to buy, we're going to put 25% into Microstrategy and 75% into Ultra Option Income Strategy, both YieldMax funds. Microstrategy yields 140% a year, an expense of 99.99%, which is pretty high. And they use covered call strategies and Microstrategy. Microstrategy was a traditional software operations company. Now it's a treasury first corporate model. And by treasury, they mean that they just buy a bunch of Bitcoin. So they own almost 600,000 Bitcoin, and that is worth now $71 billion in value. So, that's a lot of Bitcoin. I am pretty bullish in crypto. I think that as Bitcoin moves up, MicroStrategy will keep moving up, and I think that should sustain the price and the yield in the near term, and that's kind of the thesis with that. But given it's one company, I don't want to put more than, even 25% is kind of a high allocation, but I feel reasonably comfortable with that. And then next we have the Ultra Option Income Strategy by YieldMax, and that yields 80%, and it has a decently high expense ratio of 1.3%. And that does covered call strategies as well, 15 to 30 US securities, because they're very volatile. So that creates a lot of yield. And since they hold a bunch of different stocks and funds like Palantir, Coinbase, Nvidia, there's a little more security, because even if MicroStrategy goes down, ULTY is not going to go away. Recently, it's had a pretty big drop until they started paying weekly, and they also changed their strategy from relying on one strategy to basically being able to adjust, like a hedge fund, essentially, their holdings of strategy as the market conditions change. And then since then, for the past, I think, 4 months, the NAV stopped cratering, and now it's pretty flat, and it's been doing pretty well. So I want to put 75% into ULTY. So $10,000 to start, 25% in MSTY, 75% in ULTY, and then we're going to start tracking this moving forward. I'm excited. I think this should be a very fun exercise, and yeah, I think that's it. Until next quarter, today is July 13th, 2025. We're just going to call this the start of Q1, even though we're 13 days in, and then we will talk in Q2. All right. Thanks, guys. I'm an administrator.
decision.